Hi, it's Mark Nugent here. Welcome to this video where I'm going to show you how the FTF robot actually works. What the robot is actually doing is it's using indicators to look for a trend. Now this is a little bit of a chart. I think it was pound dollar. And in this chart, just for the sake of contrast, red is a movement down and green is a movement up. So you can see here a reasonable trend has been established. Now what the robot has built into it is a series of indicators that will help us to understand if the trend is actually strong, sufficiently strong to merit us placing a trade on this information. Here we are back at an instance of MetaTrader 4, and we can see here in the navigation pane what we normally see here is the account screen, and we see the expert advisors. But if we click down here, we can see custom indicators. And these indicators, there's many of them, over 1,500, and you can also design your own indicators. What they basically are arithmetical calculations of recent price movements and volume movements, that's how much activity there is in the market, that try to identify either trends or reversals where the currency changes direction. So again, basically they are arithmetical analyses of recent price activity that try and give an indication of the strength of a movement or the strength of a reversal. So here we are back at the schematic. We see a trend here, and this thin blue line is supposed to represent the current price. Within the robot we have a number of indicators, and when every single one of them is indicating that we have a strong trend, that to us is an entry signal, a signal to enter a trade. So it's either a buy signal because we think the currency is going to continue to rise, or it's a sell signal because we think the currency is going to decline. The signal is at the current price, the so-called market price, and the size of the trade measured in lots is defined by the user in the settings. So that's you, or it's me if you go with the current best strategy. So for the purposes of this example, let's assume that we're looking at a buy trend, a buy trade, because we think this trend is going to continue in the upwards direction. Also, at the same point at which the trade is entered, a stop loss is defined for the trade as well. Now again, the distance between the entry price and the stop loss is measured in pips. A pip is a 10,000th of a currency unit, and that's also defined by the user as well. So that's again you, or it's me if we're looking at the current best strategy. The stop loss allows us to actually define the maximum we are prepared to lose on any particular trade. In the trading I do, this distance here between the entry price and the stop loss is never more than 1 to 2% of the size of the account. So you can't actually lose more than whatever the stop loss is, and this is a way of actually successfully managing risk. With stop losses, there's no scenario where you can actually take a significantly large loss. So how do we actually exit our trades presuming the stop loss isn't hit? There's two profitable exit strategies. Here's the first one. We set a take profit. Again, at the same time as the original trade is placed, there is a take profit a certain number of pips above the entry price, and again it's defined by the user, that's you, or it's me if it's the current best strategy you're using. So now the trade is set up, we've got the entry price, we've put our money on the table, which is the number of lots. It's a buy or a sell, in this case it's a buy, and we're basically saying if the price goes down to the stop loss, close the trade at a small loss. If it goes up and hits the take profit, close the trade at a small profit. So that's exit strategy number one, take profit. Here we have the same scenario. We have the entry price, we have the stop loss, and we have the current price because we've just placed this trade, and we have exit strategy number two. It's called a trailing stop loss. Now here's an example. You'll notice here that the current price has actually moved up. It's moved up by 20 pips. You can see that here. It's gone from 1.6000 to 1.6020. That's 20 pips. A pip is the fourth decimal place, so that's units there, and the third decimal place is obviously tens, or in this case thousandths, but that's 20 pips, 20 pips there. So the price has gone up by 20 pips, and if we have a trailing stop set at 20 pips, which again is user defined, then when the price moves up by the amount of the trailing stop, what happens is a trailing stop is established 20 pips behind the current price, which in this case is at the entry price. So now with the trailing stop at break even, no loss can occur, and this is how no loss can occur. The trailing stop is going to follow the current price up, lagging it by 20 pips. So if this current price moves up, the trailing stop will follow it in lockstep 20 pips behind it. If the current price reverses, the trailing stop will immediately stop moving and will just stay there. It won't go back down, maintaining the distance of 20 pips. It won't do that. If the current price reverses, the trailing stop will simply just stop and remain stationary as the current price approaches it. So the distance between the price and the trailing stop will always be 20 pips or less in the case where the price comes back down. But the trailing stop will only ever move up. So eventually of course, the current price will actually come back so much that it hits the trailing stop. But by this time it could be away up here somewhere, but it will never be back in the loss-making position. Also note, in this case, as soon as the trailing stop is established, the original stop loss is cancelled. It's no longer relevant. The price can never go back into the loss-making position, because to do that it would have to pass through the trailing stop, and that's not going to happen. This strategy leads to more profits but smaller profits. It's slightly misleading to call this trailing stop a trailing stop, because a trailing stop is usually associated with some kind of loss. I think it would be better if it was called a trailing profit, but that's not the industry nomenclature, so we have to stick with trailing stop. Now here is a little example of a current best strategy. It may not be the one that's in place just now as you look at this video, and I'm not going to go through this in detail, but really the relevant bit in terms of this video is at the bottom here. So here we have one strategy with a very simple stop loss and take profit, in this case 60 pips and 20 pips respectively, and that's example one of a positive a profitable exit strategy. And then with these two pairs, euro dollar and New Zealand dollar, US dollar, we have the trailing stop example with a stop loss originally 80 pips below the entry price in the case of a buy, with a trailing stop at 10 pips. So that means as soon as the price gets 10 pips into the profit, the trailing stop will be triggered at break even, and then we can't lose any money, and it's just a question of how much money we actually make. I hope this video has been useful. It's a very simple, high-level overview of how the FTF robot actually works. Thanks for watching.